So whenever you are using options trading strategies that involve selling options, so that includes things like credit spreads, iron condors, cash secured puts, covered calls, things like that, there's always the risk or the chance that you could get assigned early on those short contracts, or basically before the expiration date. Now that being said, the risk of an early assignment is typically very small the majority of the time, but there are some very specific conditions that if you find yourself encountering, the risk of an early assignment does increase drastically. And so that is the exact topic I'll be discussing in today's video. Specifically, I'll be explaining in great detail those exact conditions where early assignment risk becomes very significant. Now, as always, before we dive in here, in case you are brand new to the channel, my name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Okay, and so the first concept you must understand before we really dive into the nitty-gritty details here is you must understand the difference between extrinsic value and intrinsic value. So these are basically the two main components that make up the price of any option contract. Now I do also have an older video that takes a deep dive into these two topics specifically, and I'll post a card above linking to it, but I'll still summarize them here. So the intrinsic value of an option contract is basically the worth of the option if right now was the expiration. So it's basically the inherent worth of the contract. And you can very easily calculate how much intrinsic value an option has just by looking at how far in the money the contract is. So that's why, of course, if expiration was right now, all the contracts that are out of the money, those always have a price of exactly zero. There is no worth to them anymore. They have no intrinsic value. But for options that expire in the money, they're always going to have some inherent worth. And again, that is the intrinsic value of the contract. Now that being said, if there actually is some time between now and the actual expiration date, then the price of that option contract is going to be worth more than the intrinsic value. And so that is where the concept of extrinsic value comes into play. So basically, extrinsic value is simply the worth of an option in excess of its intrinsic value. And the way you calculate this component of an option's worth is simply by taking the current price of the contract and subtracting from it the intrinsic value. And also a different or perhaps a better way of understanding what extrinsic value actually is it's basically the time value that's remaining in the contract, right? Because as with all investments or all trades, there's always worth in the amount of time that you have left between now and the end of the trade or the end of the investment. And that's because, of course, the more time that you have, the greater the chance that you could be profitable on that position. So again, if you are buying call options or selling call options, and if those contracts expire in 2 months, that's a long time for the stock, for example, to move in a favorable direction for you to make money on those trades. And then conversely, if there's only, let's say, 1 week until the expiration date, well, that's not a lot of time for the stock to move in your favor. So ultimately, the more time a contract has between now and the expiration date, the more valuable that time is, and therefore the greater the option price will be. Now, another very important aspect of extrinsic value that you must understand is that this is the component of an option's price that does actually decay over time. So essentially, if you've heard of the concept of time decay or theta decay, which is the fact that as time moves forward, all option contracts will lose their value, then again, the actual piece of an option's price which does actually decay is its extrinsic value. And hopefully that should make sense because again, as there is less and less time between now and the expiration date, of course, that decreasing amount of time is going to have decreasing value. And then finally, one more important fact of extrinsic value that you must understand is that super far in the money options and super far out of the money options always have the least amount of extrinsic value. And that's because for the super far out of the money contracts, the chance that those contracts will be worth something by the expiration date is almost zero. So that's why their prices are almost zero. They have no intrinsic value and almost no extrinsic value. And then for the options that are super far in the money, the chance that those contracts will be valuable by the expiration date is very high. And so that's why they're already trading like the stock positions that they're going to give you by the expiration date. So basically, it's only the options that are close to at the money with strike prices that are basically very close to the current price of the stock. Those are the options that have the most extrinsic value. And that's because those contracts are basically right on the edge of potentially being useful or not useful by the expiration date. So that's why the time remaining between now and the actual expiration date has the most value for those contracts. Okay, and so with that being said, and also don't worry if that was a bit confusing, I'm going to show you some very detailed examples here in a second, but the main thing you want to keep in mind in this video, specifically those conditions where early assignment risk becomes significant, is when the options that you're selling are both in the money currently and also there is very little to no extrinsic value remaining in those contracts. And that's because if the buyer of the contract that you sold decides to exercise that contract early, they are going to forfeit any remaining extrinsic value in the contract. It's basically like lighting some of their profits on fire. But of course, if there is little to no extrinsic value remaining in the contract, then it does not matter if they exercise early. So again, keep those two conditions in mind. The option that you have sold must be both currently in the money and also there must be very little to no extrinsic value remaining in that contract. And so now at this point, we're going to jump on over to ThinkOrSwim here. And like I mentioned, I'll be showing you some very detailed examples that will make everything I just said super, super clear. Okay, so the stock I'll be using here in my examples is going to be SPY. And this is actually an ETF that tracks the S&P 500. So it's typically a very, very heavily traded asset, both in terms of the ETF itself and also all the options on it too. So now let's say, for example, and I'll zoom in a little bit here on the chart. Let's say that back during this time, which was in late December of 2021, that you were still bullish on the market in general. And so somewhere around here, you decided to sell a simple put option, and specifically an out of the money put option, and we'll say perhaps around the 475 strike. So perhaps maybe you open that position on this day where SPY closed at around 477 bucks per share. So again, this put option is a little bit out of the money, but also could have been at the money as well. Either way, the point here is you are bullish on the S&P 500, and so that's why you sold that put option. And also, please do keep in mind that even though my example here is just with a simple naked put option, this does also apply to selling a put credit spread as well, right? Again, any kind of option trading strategy that you use, which involves selling options, those kinds of strategies always have some level of risk of getting assigned early. And then let's also say, to make our example a bit more concrete, that you sold a 475 strike put option for exactly 400 bucks in premium, or 400 bucks as a credit. So that means, of course, your account is credited by that amount, and the person who purchased that option from you had to pay, of course, that 400 bucks in premium. Now, however, if we fast forward time to the present, unfortunately, as you can see pretty obviously here, that trade is not working out so well. Right, as of yesterday's market close, SPY finished at around 438 bucks per share, far, far below your 475 strike put option. So now this means because your put option is so far in the money at the moment, you could be at risk at getting assigned early on this contract because, as I explained earlier, options that are super far in the money are going to have very, very little extrinsic value remaining, even with some decent amount of time left until the expiration date. And so at this point, let's come over to the trade tab now and take a look at a few expiration cycles and specifically the 475 strike put options in those various cycles. And through these examples, you're going to see how much extrinsic value is remaining in those contracts based on exactly how much time is left to the expiration day. Because again, also keep in mind that if there is some extrinsic value remaining in the contract, that amount is still going to be slowly eaten away as time marches forward. So first off here, let's go into the February 7th expiration cycle. This is a weekly contract with 16 days left to go until the actual expiration date. So let's unfold that tab there. And now if you scroll down a little bit, right here would be your 475 strike put option. So again, as I showed you on the chart, at the time that you sold this put option, it was basically at the money or slightly out of the money. But now, having fast forwarded to the present, as you can see clearly just how far in the money this option is at the moment. So the first step here is to figure out exactly how much intrinsic value is currently in this contract. Because based on the current price of the option and then also the intrinsic value in the contract, we need those two things to then figure out the extrinsic value remaining in the option. So briefly here, let me go ahead and pull up the calculator and I'll move this right there. And so the fair price for this 475 strike put option is going to be basically right in between the bid and ask spread. So the bid price is $36.79 on a per share basis. And then if we add to that the asking price of $37.50, $37.59. And then finally divide that by 2 to basically get the average between those two prices. That means the fair price for this contract is $37.19. So now the next step is from the actual current price of this contract, we now have to figure out the amount of intrinsic value. So to do that, I'm going to go ahead and clear the screen here. And as I explained earlier, the intrinsic value of an option is simply the price that it would be worth if right now was expiration. And that value is equal to simply how far in the money this option is right now. So with a 475 strike, and with the current price of SPY as of the market close at 437.98, we simply subtract that number, 437.98 cents, and therefore we get $37.02. That's exactly how far in the money this contract is right now, and that's also the intrinsic value. If expiration was right now, then the exact price of this option would fall down to exactly $37.02, and therefore there would be no extrinsic value remaining. But as I just showed you also in the previous calculation, the actual current price or the fair price for that contract is actually $37.19. It's a little bit larger. So that means this contract still has 17 cents of extrinsic value remaining. And again, this is all on a per share basis. So times 100 shares, the total extrinsic value in this contract is $17. And so if the buyer of this 475 strike put option wanted to exercise the contract right now, which is still about 2 weeks from expiration, then they're going to forfeit this remaining extrinsic value. They're going to lose out on keeping an extra $17 essentially, right? Because the full picture here is initially you sold that put option for $400, and that's what the buyer paid, obviously. And now if the buyer of the put option wanted to exercise this contract right now, that gives the put buyer the right to sell 100 shares at the strike price of $475, right? Now, if the put buyer does not currently have those 100 shares in their portfolio, then they can simply buy them first at the market price, which, as I showed you, would be $437.98 per share. Again, just going off the closing price of SPY. So they would buy 100 shares at $437.98, then exercise the contract and sell them at a higher price of $475. And that makes for a profit of $37.02 per share, which times 100 shares is a total profit of $3,702. And then, of course, as I mentioned, they initially paid $400 to buy that contract in the first place, so we subtract 400, and so in the end, that leaves a total net profit of $3,302. This is what the put buyer would make if they exercise the contract right now. But now let's say the put buyer was also considering maybe just selling the contract and booking their profits that way. So again, they initially paid $400 to buy the contract in the first place. And then as I showed you, the actual current fair price for the put contract right now is $37.19 on a per share basis. So in total, the fair price is $3,719. So the put buyer could sell the contract at that price at $37.19. And then, of course, if we subtract the initial $400 paid for the contract, that leaves a total net profit of $3,319, which is $17 more in profit than if they instead exercise the contract. So hopefully through that example, it makes it clear that by exercising early, the option buyer will forfeit any remaining extrinsic value in the contract. So that means in this case here, with still 16 days left to go, which of course is still giving this contract some additional time value or extrinsic value, then perhaps at this point in time, the buyer of this contract would not choose to exercise it early. And therefore, as of right now, you as the seller of this contract would probably be pretty safe still. I would say it's still unlikely that you would get assigned on this contract. But now let's say, instead of selling the February 7th expiration cycle, let's say back in December when you first put on this position, you actually sold the January 31st cycle. So these options only have 9 days left until expiration. So now once again, let's scroll down and find the 475 strike put option. And let's figure out how much extrinsic value is remaining in this option. So once again, let's go ahead and pull up the calculator. And so as I showed you, the fair price for this contract is simply going right in between the bid and the ask prices. So the bid price is $36.75. Add to that the asking price of $37.46, and then we just divide that by 2. So there we go. The fair price for this option, just rounding down a little bit, is $37 and call it 10 cents. And so also because we're still dealing with the same 475 strike put option, this contract is still going to have the same exact amount of intrinsic value as with the February contract that I showed you first, right? Because 475 minus 437.98 is still $37.02. So now here, if we subtract that exact same amount of intrinsic value, $37.02, then for this contract, which expires in only 9 days, there is still some remaining extrinsic value left, but it's obviously about half. It's only about 8 cents or so. Or again, times 100, $8 in total. So that means here, once again, if the buyer of this put contract decided to exercise it right now, then they would forfeit $8.50 of their profit. Now at this point, the buyer of the contract may actually start to consider doing this, right? Because the alternative is just selling the contract for the current price. But that is also dependent on them being able to sell the contract at the actual fair price. And oftentimes when options go super far in the money like this, it's very difficult to either sell or buy the contract at the fair price, basically right in between the bid and the ask. Now that being said, these are SPY options, and as I explained, these options and the ETF itself are among the most liquid or heavily traded products in the entire marketplace. So chances are for SPY, you could definitely still get filled at a very, very good price here, even with these super far in the money options. But if in the case you are trading something a little bit less liquid, perhaps some more obscure individual stock, then you will definitely find it much, much more difficult to get filled at a good price when trading far in the money options, both for the seller of the option and also for the buyer. So therefore, if the buyer of the put contract is worried that they may not get filled at a good price if they try to sell the contract, and perhaps through a very bad fill, they might lose more than the extrinsic value remaining in the contract, then in that case, they may decide to instead just exercise it. And then finally here, as one last example, let's say instead of selling the January 31st cycle, you actually sold the January 24th cycle, and these options expire in only 2 days. So one last time, very quickly, let's go down here and find the 475 strike put option, and then we'll bring back the calculator once more. And so the fair price for this contract, again going right in between the bid and the ask prices, bid price is $36.72. The asking price is $37.44, so dividing that by 2, the fair price for this contract, same put option but expiring in 2 days, is $37.08. And then of course, because it is still the same strike put option, it still has the same amount of intrinsic value. So if we subtract from this, the same $37.02 of intrinsic value, that means with this contract, there is still 6 cents of remaining extrinsic value. And that's on a per share basis. So once more, multiplying by 100, the total amount of extrinsic value remaining is $6. So I just wanted to show you this final example here to illustrate that even with only 2 days left to go into the expiration day, and even with the option being super far in the money, chances are there's still going to be a little bit of extrinsic value remaining. So therefore, even in this case, as I showed you in the previous example, I do think there is definitely some risk of getting assigned early on this contract right here, mostly because the buyer of the contract may be worried that they'll lose more than $6 by trying to sell the contract. But point being, even in situations just like this, it's still not a guarantee that you're going to get assigned early. It's definitely much more likely in this case, but still not a certainty. And so finally in this video, just to give you a few tips on how to either avoid or handle an early assignment. In the case where you are trading credit spreads or debit spreads or iron condors, if you do get assigned early on your short leg, you can simply exercise early your long leg of the position, and that will totally cancel everything out. Right? For example, in the case of a put credit spread, if you get assigned on the short leg, which means you have to purchase 100 shares at the strike price, then again, you can just exercise the long leg, which will therefore sell those shares that you had to buy, and again, that cancels everything out. Same thing with call credit spreads and debit spreads and iron condors. And then in the case if you are trading naked options or cash secured puts or covered calls, things like that, where you don't actually have a long leg or a long option as part of your strategy, then in those cases, if you want to avoid assignment, you can simply roll the contract out in time, which basically means you buy back the initial contract that you sold, and then you sell the exact same contract, same strike, or perhaps very similar, but in a further dated expiration cycle. And so by doing that, when you basically move your position further out in time, that's going to give your new short contract a lot more extrinsic value to it. And then the alternative to that is to also have a corresponding stock position with the options that you're selling. So in the case of a covered call, when you first buy those 100 shares and then sell the call option, those 100 shares can always be used to meet your obligations if you actually get assigned on that call option. Or if you have 100 shares of short stock and then you sell a put option, same kind of thing. The short shares of stock will always cover your obligations if you get assigned on the put option. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.